Most traders are obsessed with win rates. They want 80%, 90%, and even 95% win rate. What if I told you you don't need to win most of your trades to make money in the Forex market? In fact, some of the most consistently profitable traders win less than 50% of the time. Today, I will break it down for you. Why win rates is misleading, the maths that actually matters, and how it can be profitable even if you lose 65% of the time. I guess it's the first question that comes to your mind is, what the fuck? But just relax, calm down. Let me break it down for you so that you can get to understand. Win rate is just an illusion, and I'm going to illustrate that in this particular video. Just be patient. So right here, we're going to compare two traders, trader A and trader B. Trader A, you can see that he has a 90% win rate. Risk to reward, his risk is $100. He makes $50 per win, and he loses $300 per trade. And trader B, on the other hand, has a win rate of 40%. His risk is $100, risk $100, makes $400 per win per trade. Now let's look at this over 10 trades, okay? Trading is all about numbers, okay? It's not about the person who is more consistent or thereabout. It's not about that. So over 10 trades, you can see that trader A is having 9 wins with a $450 profit and 1 loss, which nearly wipes out his entire profit, and he ends up with a net profit of $150. But what if the loss becomes emotional or he moves stop loss? And one bad loss wipes 5 to 6 wins. Meanwhile, trader B, on the other hand, over 10 trades, trader B has 4 wins. That's his risk to reward ratio. His win rate of 40%, sorry. He makes $1,600 in profit, as you guys can clearly see here, and he loses $600. His net profit of $1,000. Lower win rate is higher probability. Okay? I repeat that again. Lower win rate, higher probability. Higher win rate is equal to stress, you understand? You have to keep up with consistency. You get? So the only formula that actually matters in trading, I'm just going to be showing you guys this right here, right now. What actually matters, okay? Expectancy. This is what the professional traders track, non-win rate. Expectancy is equals to our win rate times the average win minus our loss multiplied by the average loss. Let's give a practical example. A win rate of 35%. Our average risk to reward ratio of 1:5. Okay, out of 20 trades, you have 7 wins and 5 are. With your 5-hour risk to reward ratio, a net total of 35 hours, 13 losses, and our average loss per trade is 1 hour. We have a total of 13 hours. Our net profit is plus 22 hours. That means you can be wrong 65% of the time and still grow your account. Now, why do retail traders chase win rates? Okay? This is purely psychological. Humans hate being wrong. They're actually wired to win. Humans are actually wired for survival. Okay? So traders take small profit quickly. They let losses run. They avoid stop loss. They fear big targets. They want to feel right, not profitable. I've been there. I've done that over time, and I decided to change. Trading rewards the numbers. It rewards consistency, not perfection, and not ego. The most dangerous strategy is scalping, okay? Some people can be profitable with that, but I actually don't feel comfortable with that because those numbers are actually too quick, they move too fast, and at any point in time, I can lose my trading psychology and I begin to do nonsense on the chart. So I don't trust myself with that. So let's say you're a scalper with a 90% win rate, risking $100 to make a 50. You can, it works, yeah, until one loss wipes out 10 wins. And then the pressure starts, reverse trading starts, and then the account is gone. Parts connect strongly with traders under pressure. High win rates gives emotional comfort. Risk to reward ratio builds wealth. What actually matters in trading is risk per trade, which is 1 to 2% max. Risk to reward ratio, the minimum risk to reward ratio should be 1:3. A fixed position sizing. Journal your trade and track your monthly performance. Think in multiples of hours and not dollars, because when you think in dollars, you begin to make stupid mistakes on the charts. All right. So I'll be showing you guys, in case you trade the synthetic market, some examples how you can actually do this and not chase the forex market. Okay. There are many strategies you can actually use. There's no holy grail, but if you follow the system just the way I've shown you guys, you're actually going to make money from the forex market. Okay. There's no holy grail anywhere. All that matters is sticking to the numbers. No matter how your win rate sucks, if you stick to what works, you're going to make money from the forex market. All right. So now let's look at this particular trade. Let me just remove the shinies on my chart. All right. So right here, you can see that there is actually our model. Our trading model is actually somewhere here. So you have to train your eyes to be able to see these things. Now let's look at a particular example, VIX 75. Okay, VIX 75 was a good setup. Okay, guys, and I actually took that one, and it worked perfectly well. So I'll be showing you guys this particular exact method and how I actually do this that actually worked for me. All right, there was another trade I took that was VIX 50. It actually took a long while, but finally it smashed my TP. Why did I actually take this trade? Okay, so I came to my smaller time frame. All right, I was looking for this pattern. All right, in a way, okay, there was this pattern here. Okay, right here, you can see this is the pattern we're actually looking for. All right, for the synthetic market. Okay, all right, you want a sweep of liquidity, a break of structure. All right, so I haven't stopped using this particular trading strategy for the synthetic market. Okay, so it actually works. So what you want is simply this: you want a sweep of liquidity, which is this particular area right here, and you want a break of structure, which is right here. Okay, you want a break of structure, which is right there, and then you want a pull back. Okay, to create our structural liquidity, which the market will actually come back to take, and then you want another break of structure, which is right here. All right. So if you want to actually understand this particular strategy, go back to some of my videos, because here already we have actually consumed a lot of time, and there's no time for that. Okay. So this is the simple model. It's simple, it's precise, and it works. Okay. It gives you everything you actually need to succeed. All right. So what I do is, before every day I form my account with probably maybe $20 if that's what I want to reach for the day, or maybe $50 and so on. I do expose myself to so much risk, okay, because anything can happen, okay. And this strategy we actually start here. All right, so right here you can see that this market created a low and then created a high before coming back to actually sweep this area. So what happens? That means we have our sweep of liquidity right there, okay. That becomes our sweep of liquidity right there. So now we are actually waiting for a breakout, okay. So we have a breakout right here, okay, which is our break of structure. Right. So this particular strategy, we have type A, type B, and type C setup. Okay. If you go to my videos, you'll be able to see it there. So this is the type B setup, okay, where the structural liquidity is internal, not the structural liquidity is internal. It does not just happen like that. It's not out external. Okay. So this one, it happens on the inside. Like for instance, now let's say the pattern happens like this. We have a sweep. Okay. Sorry, guys, just that it did not happen like this. Okay. And then it did not happen like that. But what actually happened was simply this. Okay. All right. Okay. Yeah. So this is what actually happened. This is the model that actually happened. Okay. So that's what actually happened. That's the type B setup. Okay. So now what happened? The market actually traded into that area. All right. And here we have our protected low. Okay. So the protected low is meant to be remain protected. All right. So we're just going to scale down to a small time frame and see how we could have taken that. All right. You want to actually get confirmation. With this candle, you can clearly see that, okay, we want a confirmation from the smaller time frame. You can use the 5 minutes to 3 minutes for your confirmation, and then you just enter your trades upon those confirmation. Okay. So right here, you can clearly see that we have a 3 candlestick pattern, and the other candle broke above. Okay. You can just put your entries there. All right. So you see, I've just gotten out at a 1:8 risk to reward ratio, which is actually fine. Okay. You don't have to be greedy. Okay. You don't have to be greedy. See the stop loss. Okay. If you're wrong, you're wrong. Okay. You don't have to be. It's just a quick entry in and out. All right. So right here, guys, it's still the same thing. Okay. But this one happens to be the A plus model. All right. So this is the A plus model right here. Okay. So you have an up push, you have a sweep. All right. So this one works perfectly well. These are A plus model, right? So this is why this particular one works so well. All right. So let's say you started the day with, you want to risk a $50. All right. Let's say you have a $10 and you want to risk 5% of your trading account for the day. So you just check, you see the setup here. There's an A plus setup. You can stack your positions, and even with $50, you can be able to make $1,000 from it, $500 from it. Why? Because you are using this my high probability trading setup. You have a sweep there. You have a break of structure, which is right there, guys. All right. So that's our break of structure. You have a pullback, which provides our structural liquidity, and you have our second break of structure. Okay. So you have our second break of structure. What happens is you wait for the market to actually go into that area. Okay. And you need candles like this. These are strong candles. Okay. For confirmation. But sometimes I prefer to actually enter that area. Okay. So you see, you just enter. What happened? This one actually went straight up to TP. Okay. So you have, are you seeing it? See the 16-hour on a single trade. Tell me, even if you are actually, even if you're actually having a win rate of 20%, okay, guys, you make money with this strategy massively, guys. Don't forget to hit the like button and subscribe to this YouTube channel for more and more banger videos like this. Okay, follow us on the Telegram channel where we provide good signals for you. All right, so now let's look at the last one. Okay, VIX 50. VIX 50 has actually been selling for days. Okay, so it was the same principle, guys. Nothing different. Nothing different. Okay, let's go to our 4 hours time frame and look at things from there. Okay, why is it not opening, guys? Okay, from the VIX 50 index, okay, you can clearly see this area right here. Okay, all right, so we can see this, that we have a sweep of liquidity, which is right here. Okay, and we'll have a break of structure, which is right here. All right, so you can just go practice that. Okay, I'll just put a screenshot of that trade. All right, here. Okay, and then this was our PY. PY stands for points of interest. There are other videos which I've actually done about this. So let me just show you guys. The market just entered there. All right, but the key important thing is this: there was a sweep of our structural liquidity. Okay, before the market gave us confirmations, and then we entered. So you can see that rejection in the 1 hour. So yes, so you see, very, very simple trade. Okay, and then we waited for a good number of days before we hit our TP. Don't forget to hit the like button. Follow us on the YouTube channel for more videos like this, fam. For more videos like this. So you see, this is very, very simple, and market played out nicely well. So I'm giving you the best of strategies, fam.